Today we're going over the 8 simple steps to build wealth and secure your financial future. By the end, you'll know exactly what your next move shall be. Get the order wrong, and it could end up costing you. Over the years, I've worked closely with people and their money. When people have a clear path to follow, money starts to feel easy. So what are these 8 simple steps? Let's break them down. Step 1 is simple. You're going to save enough money to pay your largest insurance deductible should you have to file a claim. This money is going to serve as a cushion so that you don't have to stress when life happens. It's your first line of defense. It's going to stop you from putting those expenses on a credit card. Now, the funds here are supposed to be kept in a low-risk, high-yield savings account that's FDIC insured. Pro tip, keep this account separate from your daily transactions so you don't accidentally spend it. Now, everybody's target here is going to be different. You'll need to check your own policies. For example, say your auto policy had $500 deductible. Health insurance was $2,500 and your homeowner is $2,000. Your number, $2,500, the biggest one. Now, one big mistake people make here is investing this money, searching for a higher return. Yes, there are ways to make more than a savings account will pay you, but that's not the job of this money. This money's job is to be there in case of a rainy day. Think of it like a spare tire in your trunk. Not that exciting, but you're happy to have it when you need it. Earning a higher return on this money is not going to change your future, but if it's not there when you need it, that really could. So leave this money for a rainy day. If you need to tap into it, don't feel bad. Just make a plan to replenish it as soon as possible. Having this money set aside is the safest and easiest way to have peace of mind without waiting to build a full emergency fund. Now, once you've funded this step, you can move on to step 2. I'm talking about getting the match on your employer's retirement plan. So if you have a job that offers a 401k and your employer will put money into it based on what you contribute, make sure you get that full employer match. Some plans are going to give you a 25% match, some a 50% match, some up to 100%. I've seen a plan that offers a dollar-for-dollar match up to the annual contribution limit. That's an extra $23,500 a year from that employer. So check to see what your plan offers. Now, one catch here is that some plans will make you earn their contribution by staying a few years. This is called vesting. If you leave your job too soon, you may not be entitled to all of the money that your employer put in. So again, just check to see what your plan offers. If you're self-employed or you don't have a retirement plan at work, that's okay. Go ahead to step 3. For everybody else, take this free win. You're still going to need the later steps in the video to hit your goals, but this is going to give you a quick boost to your savings. So next, we're going to tackle something that quietly drains your progress if you ignore it. Step 3 is getting rid of any debt over 6% interest rate. This is usually going to include credit cards, buy now, pay later plans. In some cases, it's going to be your auto loan or student loan. Paying off these debts is a risk-free way to save money. Every dollar that you get rid of, you'll never pay interest on again. Think of high interest debt like a bucket with a hole in it. It doesn't matter how much water you pour in if you don't fix the hole at the bottom. For example, knocking out a $2,000 loan with a 10% interest rate will save you $200 a year in interest. That's a guaranteed 10% return. Beyond the math, paying off your high interest debt is going to reduce your stress and make you feel a sense of control. So why 6%? After taxes and fees, 6% is a conservative estimate of what you'll earn in the market over the long term with a diversified portfolio. So how do we pay off the debt? There's 2 choices here. You can do the avalanche method. This is where you pay off the debt with the highest interest rate. It's going to save you the most money in the long term. Your other option is the snowball method. The snowball method, you focus on the debts with the smallest balance first, and then as you pay those off, you accelerate your payments on the larger debts. Both methods are going to work. It's about finding what works for you and sticking to it. Clearing out your high interest debt is going to ensure your money is working for you in the most efficient way possible. It's important because, let's be honest, life is going to throw things at you, unexpected things. So that's where step 4 comes in. Step 4 is about building your unplanned events fund. So great job. You've already started this step. The money you saved in step 1 counts here in step 4. So you can keep building your unplanned events fund in the same account you used in step 1. So here's the big question. How big should your unplanned events fund be? Well, everybody's is going to be different. 3 months of expenses is a solid cushion. 6 months is the default target for most people. And then if you're self-employed or you're nearing retirement, 12 months or more might be your target. It's up to you. Not sure where to start? Go ahead and go with 6 months and then adjust once you get there. If you're not sure what you spend each month, that's okay. Don't worry about running out and tracking every little expense unless you want to. Instead, just look at your bank account and the money that hits it each month. Subtract any money you saved, and for now, let's just assume the rest gets spent. That's going to give us a great place to start. So if your expenses are, say, $4,000 for the month, and you want a 3-month cushion, well, then your unplanned events fund would be $12,000. If you want 6 months, $24,000. 12 months, $48,000. That's it. Just multiply those expenses by the number of months you want to cover, and that is your target. So you might be thinking, why would I call it an unplanned events fund and not an emergency fund like everybody else? I like unplanned events fund because I think this money is here for all of life's surprises, both negative and positive. It's gonna be your safety net for when times get tough, and it's gonna be your launch pad when opportunities arise. So once step 4 is complete, the first half of the steps are done. Your foundation's secure, and you can go on to step 5, where we start focusing on growth. Step 5 is about maximizing your health savings account and your Roth IRA. These accounts are combined into a single step because in retirement, withdrawals can be tax-free. If you have access to both, I recommend focusing on the HSA first, then contribute to your Roth IRA. We're gonna prioritize that HSA because it's the only account that offers a triple tax advantage. A tax deduction when you put the money in, grows tax-free, and tax-free when you take the money out for qualified medical expenses. The Roth IRA is pretty tax efficient too, you just don't get that tax deduction up front. Now the biggest mistake I see with these accounts is people contribute, which is great, but then they leave the money in cash. I've met people with tens of thousands of dollars sitting in cash in these accounts. That means it's on the sidelines with no possibility to grow over the long term. So if you contribute, make sure your funds are invested. If you're not sure how to invest the money in the account, that's okay. A lot of people are there. Just talk with a fiduciary investment advisor and they'll help you make a strategy. Now let's talk HSA strategy. It might be tempting to pay those medical bills out of the HSA in the current year. That's okay if you need to do that to avoid putting them on a credit card or similar. But if you can cover your expenses out of pocket, go ahead and do that. Leave the money in the HSA to grow and compound tax-free. Save your receipts, and then you can always pull that money out later, penalty-free, if you need the money. Last note on the HSA is they're only available with a high deductible health plan. So if you have higher than average medical expenses, evaluate your options. A different type of plan might save you more money in the long term. Once you've taken advantage of the HSA and the Roth IRA, you're ready to move on to the next step. And that's where most people build the majority of their wealth. Step 6 is to maximize your retirement plan contributions. This is where your retirement savings are going to shift into high gear. We're back to talking about your retirement plan at work. But this time, the goal is simple. We're going to save as much as we can. In 2025, you can put up to $23,500 into these accounts. If you're over 50, that goes up to $31,000. For couples, this means you could be saving $47,000 a year and even more if you qualify for the contributions for catch-ups. If you're self-employed, depending on your income, you could save $77,500 into a retirement plan by opening your own 401k. Pretty cool, right? Now, reaching the maximum in these plans can take time. Checking off this step will often take people many years. Every increase you make now will set you up for a stronger future later. One cool thing about these plans is that many offer an automatic increase option, so enabling it will turn up your contribution percentage by a set amount each year. So 1% each year, automatically, you don't have to do anything. You'll hardly notice a difference in your paycheck, but it's gonna help you accelerate your balance over time. Some plans also offer Roth contributions, and if you wanna see a video on Roth versus pre-tax, let me know down in the comments. Once you're making the most of your workplace plans, you know you're building a solid retirement foundation. So go to step 7. Step 7 is gonna help you save in ways that give you freedom at every stage of life. Step 7 is about investing in your future. It's about working towards your desired savings rate. It's not a one-time decision. It's about building long-term habits that build over years. Now, everybody's ideal number here in step 7 is going to look different. How much you should save is going to depend on factors like your lifestyle, how much you've already saved, what your retirement goal is, and many more factors. A fiduciary advisor can help you figure out what your number is and work towards that target. Many people aim towards 20%, but if you're unsure of where to start, I recommend picking 25% as your savings target. Hitting that level is going to put you among the top savers in the United States. saving more than 5 times the average American. For households earning less than $140,000, it's going to be possible for you to hit that 25% mark inside of that HSA Roth IRA and workplace retirement plan. If that's you, great, you can go to step 8. If you're in a household that earns more than that, not a bad problem to have. But you're going to have to look for other opportunities outside of those accounts to hit that 25% mark. This is one of those places where a financial planner can help you evaluate your choices and make a plan that works for you. As you work through step 7, remember that hitting your savings target is a long-term goal. Don't get distracted by comparing yourself to others. Track your progress and see how far you've come as you look back in the future. If you're struggling to move the needle, remember, it's often easier to save more money by cutting expenses rather than earning additional income and paying more tax. If you hit your savings goal number, congratulations. You can confidently move to step 8 knowing you've set yourself up for long-term success. Now, step 8 is about empowering yourself and others. If you make it to step 8, congratulations. Most people will never make it here. You've built a strong financial foundation, and now it's about using that strength to shape your vision of the future. At this stage, you're empowered to use your financial strength in ways that align with your values and your goals. So here are some common paths that people may take in step 8. Families with children often choose to invest in a 529 account to save for the kids' education. Or they may choose to put that money into a Roth IRA if the child has income and help them jumpstart their retirement savings. It's up to them. Other people may choose to increase their lifestyle. It's okay to spend more when you reach your savings goal. So that could be traveling more, it could be upgrades to the house, or maybe they just go out to dinner more often. It's up to them. Lastly, some people choose to approach other financial goals. Step 8 is the optimal place to pay down a low interest mortgage, if that's important to you. There really is an endless amount of possibilities here in step 8, and the key is that it's about freedom. The freedom to choose what's important to you. That's the beauty of reaching step 8. It's not about what you should do, it's about what you get to do next. Now, the steps I've outlined here are designed to be followed in order, but I understand that life isn't linear like that. So you can find yourself moving forward and backward along these steps as challenges arise and opportunities come your way. So if that happens to you, don't get discouraged. Just check back in regularly with your progress and track that progress. That way, down the road, you can see just how far you've come. Let me know if you have any questions about the steps down in the comments. Thanks so much for watching. I'm Jordan Drinkhouse. If you want a free copy of the steps, they're available for download in the description. Take care. I'll see you in the next video.